Welcome back to Retirement Living, and thanks for joining us on our first episode of many in our new series, Retirement Living Interviews. Today, we will be speaking with Christopher Hensley, a financial advisor from Houston, Texas, who operates Houston First Financial Group. Christopher has also been operating the Money Matters podcast for more than a decade and has interviewed tons of financial experts and important voices on the scene. We hope you enjoy this podcast. Leave a comment below if you have any questions, and we'll try and respond as quickly as we can. Welcome to Retirement Living, your guide to and through retirement. Today we have Christopher Hensley on. He is from Houston, Texas, as a financial advisor, and he has been hosting the Money Matters podcast for now 10 years. So congratulations on that, Chris, and thanks for joining us.
Absolutely, Jeff. Thank you so much. And thanks for having me on.
Yeah, you bet. Alrighty, today we're going to go through some spot checks on how you feel about the economy and then some other scenarios here. So obviously the economy is in a very interesting position right now. Today is March 18th, 2024. Stock market is still really, really high, but that may not be the sentiment for everyday Americans and how they feel. What is your outlook on the macro environment right now?
Yeah, anytime anybody asks me about macro right now, what I'm talking about, and this is the same thing I do when I sit down and do client reviews for my client, is I start with macro and then go micro. For macro, it's all about the Fed. It's been about the Fed for the last 2 years. This is why when people pull up their statements in the last 2 years and they look at where the drag was and they saw the bond funds going down, say, well, I didn't think our bond funds could go down. Yep, they can. In fact, that's what they do in this type of environment for interest rates, right? So it shouldn't necessarily be a surprise. But I always tell people, don't fight the Fed, right? It's so important with what's going on with interest rates and how it affects the market and your portfolio. And so really, I think everybody got spoiled with where we were at last year, that now they're saying, okay, we've what they've done with interest rates has put us where we need to be, and so we're expecting interest rate cuts, and
Yeah.
so since we didn't get them right at the first quarter, people are there's that nervousness there. And when we look at the Fed and they're telling us, well, we will eventually raise rates, but we got to make sure what we're doing works, right? So they've got
Yeah.
one tool in their toolbox. It's either raise or lower rates, and
Yep.
they got to make sure that inflation is in check, right? So
Right.
if we're patient, the cuts will come, and then we'll see things go up. We got to remember, though, when everybody's looking at their cash equivalent accounts, when they look at their savings rates and their money markets, and they're even getting tempted by the CDs at the bank because
Right.
interest rates are much higher than they've been for the last 20 years, right? That when we get these cuts, a lot of times we see that stuff start to stabilize and go down. So that stuff will kind of come back down to the planet Earth there. Things to think about, yeah, for on the
For
macro
sure.
level there.
Yeah. So obviously you mentioned inflation. Inflation's been crazy over the last 2 years or so. And it definitely makes it where if you're not investing your money in the market, your money is just devaluing. Is it really reasonable for someone to pull their money out or not invest? Like, can people afford to not invest? Is the market going to leave them behind with what they've saved unless they're investing it?
So, I'm going to give you more than one answer here.
Sure.
And I think, a lot of it is based on where you're at in life and what age you're at, right?
Yep.
For most people, if you're a younger person, you can't really afford not to invest, right? The idea of buy and hold and a long-term approach and getting money into the market kind of doesn't matter where you're at. You're kind of market agnostic as far as what asset classes you're in. It's just the idea of, I need to save, I need to get money in the market. And generally that works out well over somebody's entire lifetime. Now, I work with clients who are 55 and up, who are either to 10 years away from retirement, or a good bit of the clients that I work with now are already retired. They're already on
Yeah.
the other side of it, right? So that's not such a good story when you look back at 2008, 2009, and most people had a 38% drawdown in their 401k. That
Yeah.
could make the difference between going back to work at Walmart as a greeter, as opposed to full retirement, right? It could really make a
That's
big
true.
difference if you have a drawdown right at the beginning. So as an active manager, I am somebody that as you get closer to turning your growth asset into an income asset, right? Converting it to when you actually start taking income from it.
Yeah.
I believe in things like cash and stable value. You won't hear a lot of financial advisors tell you that, but
Yeah.
so there are some times when going to safety is a good thing, but it really depends on where you're at in life, how I answer that, right?
Yeah, for
And
sure.
everybody's goals and situations going to be different. Yeah.
Yeah. So what are you seeing any trends right now in the market at large that you think will be something that will stick around in the next decade? Obviously, AI is a huge trend right now. Are you seeing anything else that you think is going to be a life-changing thing that people really need to pay attention to and watch, either for investment opportunities or that could create uncertainty in other areas?
Yeah, I mean, and that's the big one we're talking about right now is AI, right? That's the biggest um, change that we've seen in the last few years here. When interestingly enough, it's been around for a while. It's been around for many years, but where it's at now, we're seeing disruptors, right? We're
Yeah.
seeing disruptors to labor, disruptors to, I'm a big advocate of AI. We use it daily here.
Yeah.
Both me and Maria, my assistant, we went out and got certified through Vanderbilt in data analytics through Chat
Nice.
GPT. So I use it every single day.
Yeah.
So I would take that serious. This is not the com bubble here.
Yeah.
The things that we're seeing with semiconductors. Look at industries that are ancillary, right?
Yeah.
So we know that Chat GPT is the biggest name in the fight right now. But you've got Claude, you've got there's three or four other
Gemini.
ones that Gemini, yeah, yeah, we saw
Yeah.
that go from Bard to Gemini, right?
Yep.
So we've got these major players there. So I feel like it's probably not a done deal. We're going to see these companies compete for which one's going to be bigger and better, right? But the
Yeah.
technology and the idea that it's a disruptor is very real. And from an investment standpoint, the semiconductors, I always look for things that are ancillary to that, so that you're not making a big bet on one horse, right? The idea
Yeah, for
that
sure.
one weekend we walk in, Sam Altman's fired, and then we get back on Monday and he's back, right?
Yeah.
so
Yeah, that was
so
quite the series of events.
very exciting weekend. So we don't necessarily know if the other shoe is dropped and where that's going to end, right? But there are some things that we know that is not a flash in the pan. It's going to keep going. So I would look for industry and sectors that are ancillary, things that surround it. Semiconductors is
Yeah.
a big one. Energy, just the mass amount of electricity that it takes to run these things, right?
Yeah,
Um,
that's true.
being forward thinking in those sectors. I do a lot of sector rotations, so thinking about which
Yeah.
areas are affected by that. Um, Other trends that might be shaping where we're heading. Sustainability and environmental and social governance. I know when I started 20 years ago, we saw ESG funds come online, but it has just gotten more and more important as people look to kind of creating their own portfolio and expressing themselves through their own
Yeah.
beliefs. And so that's a thing that we've seen trends in. And just the aging population. We have record numbers of baby boomers that are hitting that age, that retirement age. And so
Yeah.
the things that surround that, healthcare, all of these things are things that we need to have on our radar, right?
Yeah, for sure. For sure. Yeah, you answered part of my next question on like, should people be, or how should a financial advisor set themselves apart in the world of AI? And I think you answered it with that you should be looking for a financial advisor that is going to use AI to further be effective rather than being scared of it.
Absolutely. I'll go further on that. I'll piggyback off of that. If that's the
Yeah,
question, is like, what do we do as financial advisors when AI's around, right?
yeah,
I've embraced it. I would encourage other advisors to embrace it. We had the robo advisor scare several years back that turned
yeah,
out to be a big nothing burger. I mean, there are robo advisors out there, but these
yeah.
tend to be that sophisticated, right?
Right.
And if anything, retirees need hyper personalization on their
For
financial
sure.
planning. So thinking about Social Security, healthcare benefits, right? This is that human touch that you're not gonna. I'm not scared of that. I
Yeah,
don't see there's things that AI is really, really good at, and there's things that it's not. So the idea of convenience and lower cost, anywhere we can apply AI to that, is good, but we're not quite there yet in being able to replace a human being totally from this relationship,
yeah.
and that's probably a good thing, right?
I agree. I agree. So tell me a little bit about your processes and how you tailor investment strategies for customers based on those life scenarios.
Yeah. So, I mentioned earlier that when you're younger, the idea of just buy and hold and just putting money into the market and dollar cost averaging, all of those things that we learn when we're younger are true. They work,
Yeah,
that time tested modern portfolio theory works, right? But as you get closer to retirement age, if you have a massive drawdown, it can really change the math on when you're able to retire. And so you don't really have the luxury of being agnostic as far as what's actually going on in the market, right?
yeah,
So, if your asset allocate, traditional asset allocation says 70% equity, 30% bonds, and then as you get closer to retiring, you flip it on its head, right?
yeah,
Well, we just had the conversation that with what's going on with interest rates right
yeah,
now, it's very possible that people will slowly, death by a thousand paper cuts, they'll
yeah,
slowly lose money by bond funds losing money if that's, what's going on. And that changes depending on what's going on with the Fed, right?
yeah.
But that is an argument that every single portfolio for clients should be hyper personalized, right?
Hmm.
I use capital preservation. I use active management. It's called total return. That is the investment
Nice.
philosophy that I use. It's nothing that I created. It's actually mirrored from the endowment funds. It's mirrored from the pension funds,
Nice.
and that's the style that I use. And the idea is that the things that you did to get you where you're at right now aren't necessarily going to work in the future.
Right.
The ladder that you're going to use to get there may not be the same ladder, and so that it's de-risking the portfolio where equities and mutual funds might have worked in the past. And that's not to say you won't use them moving forward, but you have to take into consideration what's actually going on into the in the market. A lot of financial advisors, they're just asset gatherers, and they'll roll
Yeah,
over non-retirement accounts and kind of blow up the portfolio. It's taxable, right?
yeah,
You don't want that to happen.
yeah,
You need to demand that your advisor take the time to look at your very specific situation and go from there, right? It's not
yeah.
cookie cutter. It's something that they need to spend the time with you to figure out what your situation is.
For sure. End up with a big tax bill if they don't.
Exactly.
All right, let's go on to the next one. So let's go to the other end of the spectrum. For someone who's just starting out or someone who feels like they're late to the game in terms of saving and investing, what would you advise them to do? Obviously not, this is not financial advice, but what principles would you give them to invest properly?
Yeah, yeah. So for younger people, you've got when you're in your 30s, your 20s, your 30s, you've got some competing goals, right? You might have children, you might be trying to buy a home, you may have brought student loan debt with you, right? Getting through
Yeah,
school. All of these are things are competing with that idea of ultimately setting money aside for retirement, right? I always encourage people because of compound interest, the magic of compound interest. Time is on your side, right? So
yeah,
so I would encourage people to save as much as they can. It's like a muscle. It's like exercising. You just have to consistently do do it, but you are competing with all of these life goals. And so making sure that you budget, making sure that you save consistently has to get in that front seat. It has to take the lead, right? For younger people. I know when I was still going out and meeting with clients at their homes, anybody under 50, when I would get there, they would try to impress me with their car, or they would talk about, I just went on this big vacation. And then anybody who was 50 and up, it would be, they just wanted to know, how much do I need to retire?
Yeah.
When can I retire? It was not about keeping up with the Joneses. All of that
Yep.
kind of material stuff kind of got pushed aside. And so the second part of your question, when you ask about, what about somebody who was late to the game? It's never too late to get started, right? You definitely will have to save more than somebody who starts when they're younger, right? You're gonna
Yeah.
have to, dollar cost average bigger chunks of your income into it, but you just have to do it, right? If you don't
Yeah.
do it, you're going to be in a spot later where you're only having Social Security in a very minor portion to supplement that, and Social
Yeah.
Security was never meant to completely offset all of your income in retirement. It
For
just
sure.
wasn't. Yeah.
For sure. So yeah, that's great. So let's go through how investing strategies would be different based on the kind of 30-year old, 40-year old, 50-year old, 60-year old. What you mentioned basically on a 30-year old, you just get started is the primary thing. Let that compounding interest work for you because it's the primary way that the magic is going to happen.
Yeah, yeah. So for somebody who's in their 30s, and I would even clump the 40s, 30s and 40s
Okay.
together, your time horizon is much longer, right? So you
Yeah.
have time to take a little bit more risk than somebody who's right there at retirement, they've done their work, they've made their money. You have the power of compound interest on your side. The more time that you have, the bigger that those accounts can get, and so you're able to be a little bit more risky with things like stocks and mutual funds, right? Now you should still do a good asset allocation and still do a good risk tolerance, right?
Yeah.
You can't cheat a risk tolerance. You can't look at your neighbors, how'd you do in your 401k and then copy, right? Because if it keeps you up at night when the market's down, that's very, very specific to you.
Yeah.
But in those 30s and 40s, being able uh, to really to save, to put that money consistently aside, out of sight, out of mind, putting money into your 401k, taking advantage of the company match, right? If you
Yeah.
don't
For sure.
take advantage of that company match, you're leaving money on the table. You
Yeah.
work so hard to get these positions, you negotiate against different employers, and one of the things you look at is for that company match. So if you don't get in there and max it all the way up to the
Yeah.
match, right, you're leaving that money on the table. Yep.
Yeah. Great. I'm going to stick on the 30 and 40s because it goes right into what you were saying. Um, so should someone in their 30s and 40s be maxing out their 401k to the maximum allowable threshold, or should they be sticking to just what they're hitting their match with?
Yeah, so that's a great question. So somebody who's in their 30s or 40s, when people ask me where should I maximize my savings at, I'm one of these people that, because I've seen so many people go from that age bracket to retirement, you'll hear that number of putting 10% aside of your savings is a good number. I've seen my most successful clients or even more aggressive go all the way up to 20%, right? So,
Wow.
so definitely maxing out the employer sponsored plan, right? There's two
Yeah.
things that they're doing there for you. One, you whatever the dollar for dollar match is, they're giving you free money, right?
Yeah.
It's tax deferred. So even if there's a voluntary account there where you're not getting a match, but you're able to let those funds grow tax deferred until you take income off of it later in life as a distribution, there's power in letting it grow without paying the taxes immediately, right? So
Yeah.
that's an argument for that. But once you've hit those buckets, and there are limits as to how much we can do through the employer. So I'm a big advocate of Roth IRAs. If you're able to put any Roth money aside, it's tax free at the end. That's
Yep.
definitely a good thing. and even cash, just being able to put money into that cash reserve. Nobody is super excited about that 3 to 6 months of committed living expenses that I always recommend
Yeah.
people do, right? But
Yep.
that's your safety net. It's not like the
Yeah.
most successful and wealthy people just take a risk and throw money into the market. They have that confidence of that safety net that if something happened, if the risk goes up and down, they've got that safety net of that cash reserve that protects them. So, yeah. Yep.
Awesome. So what about 50-year-old? What are we looking at here in terms of investments, principal strategy, and then 401k strategy as well? What should they be doing
Yeah.
as they're entering the preparation stage?
So, financial advisors' opinions are going to differ on this, but I can tell you what I do and what my investment philosophy is. And I am an active manager, which sounds a little crazy because it sounds like you're aggressive and changing stuff around, but it's actually very fiscally conservative. And one of the things that I have a conversation a lot with people about is changing your mindset from things that worked when you were younger. So, if I'm here in Houston, we might work with energy executives who've
Yeah.
gotten rich off of their oil stock or their energy stock, and then when it's time to retire, they've got an equity concentration of all energy stock, right?
Yeah.
And so it's the counterintuitive thing of changing your mindset because you're about to turn that bucket of money into income, right? So you need to not be greedy
Yeah.
and focus on the growth part of it. You need to now de-risk that portfolio. So all
Yeah.
the exciting ups and downs, roller coaster of watching the stocks go up and down, it's not that exciting when when you've made your money and you're trying
Yeah.
to make that your new paycheck, right? So
For
the idea
sure.
of capital preservation, of de-risking your portfolio, of investing in such a way that it's conscious of protecting, trying to get as much in the upside as you can, but limiting the amount of downside, right? That is
Yeah.
what I try to tell people as they get closer to those age groups, that 50, that 60-year-old, that they need to be conscious of it, or else they'll make a mistake where they end up having to work longer than they want to.
For sure. So for someone in that age range, do you recommend, so obviously for younger, the investing in that company sponsored program up to the match, do you recommend someone in their 50s going beyond that? Let's say they're late to investing. Should they go beyond and reach that catch up period? Or should they just do the match and then invest in another type of investment?
Nope, you're 100% right. I'm going to piggyback off of what you just said. The catch-up contribution that comes online at 50. This is kind of the make it or break it, right? When you get to be 50 or 60, you've either done what you needed to do or you haven't. And,
Yeah.
and I'll meet with people like this that are in that age range and they really want to retire. And the way that I can tell whether they're motivated or not is whether they do that catch-up contribution. Some people, I'd look at the math and I'm like, oh, that's just not going to happen. And I have
Yeah.
that difficult, job of telling them, man, you don't have enough savings yet. You're going to have to keep saving. So for that age range, absolutely, you do whatever it takes to keep socking money away. But I'm often very surprised because the ones that are most motivated about retiring, I'll be like, I don't think they're going to do it, and then they come back and they've done that catch up contribution, and they've got this, they're able to do it, and they also on the other end they cut their living expenses from 100 to about 70%. So if you can live off of
Nice.
about 70% of what your current income is, then you're
Yeah.
on planet Earth when it comes to
Yeah.
retiring. You're kind of budgeting for anything that bad that could come up, or not, such things that you don't have on your radar, right? Yeah.
Yeah, for sure. So last age era at 60, you're about 5 years away for most people from retiring. What do things look like for your investment strategy there?
Yeah, yeah. So you don't have much of an investment strategy at 60. 60, your investment strategy is how do I make this money last for the next 30 years? How do I make this
Yeah.
last till the day that I die? So it's about sustainability. It really does become, if they haven't learned it by now, de-risking the portfolio is a huge thing. And that's a very hard lesson because the things that worked for you when you were younger and you saw these stocks go up and you were very successful at it, it could be the thing that messes you up at the end when you're trying. So it's a different mindset
Yeah.
altogether. You have new problems. You have the problem of how am I going to pay for healthcare?
Yeah.
You turn 65, you start getting all these postcards in the mail about Medicare and, what happens if
Yeah.
I don't turn this on and that sort of stuff. Social Security is a huge part of it. People tend to underlook the idea that Social Security is about 30% of your income when you retire.
Yeah.
And are they very skeptical? Well, this may not be around when I'm when I'm of age to
Right.
take Social
Exactly.
Security, and it may be a different animal altogether. But even an additional $300 or $400 a month over 30 years, that's a huge amount of money. You
For
got to
sure.
take that serious, and the strategies of coordinating your Social Security with your investments.
Yeah.
It's not a willy-nilly thing. There is a way to be efficient about it, and be with intention when you put all of, where are you pulling your income from? Yeah.
Yeah. Awesome. So I'm going to insert a question here before the diversification question on Social Security. So for someone in their 30s or 40s, it's relatively reasonable to think that there's a strong likelihood Social Security won't be around at its current iteration. Do you make any sort of planning adjustments for that currently to kind of prepare for that? Obviously, they've got a lot of time on their side in terms of the growth, but there's less of a chance that they're going to have the reliability that someone in their 60s or 50s will have in betting that Social Security will be there.
Yeah, so I'm going to bet Social Security will be there, but I'm saying that from a position of being very plugged into what's going on with Social Security. So
Yeah,
Social Security may be a completely different animal.
yeah,
We're definitely going to have some Social Security reform, if not in the next, immediate future, in the next few years here, right?
yeah,
But it's always a good idea to be skeptical when it comes to your savings. And so it's all, I would almost say save and plan as if it's not there until you get there, and then
yeah.
like it's totally there. Because it is.
That's great.
And if you look at the two trust funds between the disability fund and the Social Security fund, the
Yeah,
disability fund would run out way before the Social Security fund. So
yeah,
the people will be running down the streets if they just take Social Security away from us
for
completely, right?
sure,
So
for
it'll be
sure.
there in some form. But for younger people, save as if it's not. It's not a horrible thing to think you're personally responsible for your own savings there. And then when you get to that age when it's time to turn it on, you need to have a conscious strategy of how to do it for you and your significant others. That it's not just about the retirement benefit, but that it's also about the survivor benefit, the
Yeah,
widow's benefit. People tend to overlook that part of it too. So
yeah,
it's about getting as much Social Security as you can, but also if you pass away, making sure you leave something behind for your spouse as well. Yeah.
for sure. Awesome. So let's go to diversification. So obviously there's some uncertainty right now in terms of the market being as high as it is. Like people are worried that things could shift and change. What sort of diversification do you advise for someone, um, be that alternative assets like gold or silver or Bitcoin, other things that have monetary value, even real estate, things that are just more physical?
Yeah, so that's an interesting one. So I would say in general, your average investor could shy away from things like gold, silver, Bitcoin, all of the things that you hear that are kind of like the hottest topic around, right? Where
Yeah,
those things exist in an investment portfolio, commodities, just as a general. So everything we just mentioned can fall under that sector or that wrapper of commodities. And I'm
yeah,
not a huge fan of commodities either, but when
yeah,
they do happen to have a negative correlation with the market. So typically when a market goes down, you'll see commodities go up, right?
yeah,
So maybe holding commodities in a sleeve, that's one of the things that we've done defensively when the market's down, and we've seen it work. But it's not a general recommendations for people to go out and just hold gold stocks or mining stocks. Or I
yeah,
mean, over the last 20 years that I've done this, I tend to get these phone calls from people who've watched the gold coin, infomercials late at night, and they call me, I
yeah,
think the sky's dropping and I need some gold coins, right?
yeah,
I tend to think of that as kind of fear-based stuff, and I would tell people to kind of shy away from it. At a minimum, always do due diligence on anything that you're going to put money in. So it's a lot of those
yeah,
companies are kind of fly by night companies there. But things
yeah,
like Bitcoin, where I as a financial advisor cannot really provide advice on this. That's what
Yeah.
FINRA's decided. I can't really
Okay.
give a recommendation on that. But I
Yeah.
can say this: I've seen funds that are comprised of cryptocurrency. Now we're, 2 or 3 years ago, we couldn't even look at it, talk about it. If a client picks up the phone and asks me, we're actually starting to see some of those cryptocurrency funds come from legitimate fund families, right?
Yeah.
From some of the bigger fund families there. So I will say, stay tuned.
Yeah.
This may change. We may be able to do something with that, but generally, most people should probably shy away from that because that's an
Yeah.
area you need to do a lot of due diligence on.
Yeah. Lots of volatility there.
Yes, absolutely.
Okay, let's see here. So, let's go to some advice on lessons that you've learned. So let's go to someone who is a younger person, who's got, let's say, average income, making 100K or so. What sort of steps would you advise them to like make sure is foundational in the way that they go about their financial future and their investing future, something that has been a game changer in other people's lives or your own even?
hmm Yeah, no, this is an easy one for me. I've got a specific client that I'm thinking of, and it's somebody who's retired. They're over $1 million. They did it right. And the strategy that they use now is not the same strategy that they used when they're younger. But I'm always going to tell people a core and satellite approach, right? So the
Yeah.
idea of having a core that is buy and hold, diversified, traditional asset allocation. When you're younger, that's just your bread and butter. You have to do that. You have to dollar
Yeah.
cost average into the market. You have to put that aside. It's going to go up, it's going to go down. You've got time for it to last. But the satellite that I've seen my most successful people do is they'll just buy sleeves of equities, right? So this is where you're being speculative. You're saying, maybe this company's depressed, maybe this company is down, and they're buying little small sleeves, right? So you wouldn't want to build an entire portfolio on it, but if this is you've got some additional income, you're talking somebody over six figures who's able to put
Yeah.
some money aside, making those small little bets. You never want to hear your financial advisor use the word bets, right?
Yeah.
But making these small little bets on companies where you're buying little sleeves of equities and just
Yeah.
putting them aside, those can really grow over your lifetime. And again, I'm not
Yeah.
recommending that for people who are going, I have to have the opposite conversation when I'm telling them to de-risk
Right.
and not hold as many stocks there. But being able to buy some of those blue chip stock companies, is a good thing when you're younger because you have the benefit of time on your side.
Yeah, for sure. So we'll go to the other side of that. What is the uh, a lesson learned or a lesson advised for someone who is 50 to 60 who's looking at their finances and is just thinking, don't know if retirement's going to happen? What sort of steps can they make today that can put them on the right path?
Yeah, so somebody who is there at that really pivotal point in their life where they're looking back and maybe they don't have enough retirement income set aside, there are some things that they can do. You're going to have to be aggressive about putting money aside. This is make it or break it. You're either going to do it or you're not going to do it, and not doing it is not really a good option, right?
Yeah.
So I mentioned, Social Security. The average Social Security for a man is about $27,000, and for a woman is about $23,000 annually, right? And that's because women have a longer life expectancy. When I give you
Yeah.
that number and you think about what you're currently making on an annual basis, it's not good, right?
Yeah.
If that's all you got, so you have that responsibility of replacing that income. And our employers help us by doing the 401k. They'll do a match, but even if there's not a match, you have the responsibility of putting that money aside and being super duper aggressive about it because it's really getting close to that time that you need to do it.
Yeah.
And then just not turning on Social Security. People are so skeptical about Social Security that they tend to turn it on as early as they possibly can. If you
Yeah.
turn Social Security on at 62, you only get about 70% of what full retirement age is.
Okay.
And I generally encourage people to push Social Security out to 70 because they end up getting an 8% delayed retirement credit for each year between full
Nice.
retirement age and 70. And that compounds annually. So when we're talking
Nice.
about the investments in the stock market, I can't guarantee that that value is going to stay the same. The market's going to go up and down. But when I'm looking at replacing your paycheck with something that is, there's nothing less safe than income coming from Social Security. It's got a cost of living adjustment. It's about
Right.
as safe as you can get. So that's where you build your floor. That's where you build your new paycheck. So having some of these Social Security strategies where you're not just willy-nilly turning on Social Security, really taking it serious, going out and educating yourself about Social Security strategies. There are some really good New York Times bestselling books out there. Lawrence Kotlikoff and Philip
Okay.
Mahler have one that's out. I would recommend that. But
Nice.
yeah, you have to take the responsibility of owning this, right? Nobody
For
else is going to
sure.
do it. There's not a big line of people standing behind you that are saying you need to, save for your retirement. That it falls on you, and tapping the shoulder of an expert if you need it. Ask for help. Yeah.
Awesome. Awesome. Well, this has been great, Chris. Go ahead and tell our viewers where they can find you online. Go ahead and let us know where to find your show.
Yeah. So there's two spots for potential clients. That's my www.houstonfirstfinancialgroup.com. We've got a complimentary consultation where you can link to that. But for people who just want to hear some of the stuff that we've talked about, over the last 10 years, I've made it my mission to go out and get thought leaders in the space for retirement and have them on the show. And so that is www.moneymatterspodcast.com. And I would point people to that.
Awesome. Well, I appreciate your time, Chris. This was a great conversation. Look forward to speaking to you again soon.
Absolutely. Jeff, thank you for inviting me on. Have a good one.
Thank you. You as well. Thanks for joining us today. Be sure to subscribe to our YouTube channel to stay up to date on our latest interviews, product reviews, and news releases. To learn more, head to retirementliving.com. And thanks again to Chris for joining us on today's podcast.